The World Bank has long faced significant criticism, especially from the Global South, for its lending practices and the stringent conditions attached to its financial aid. The roots of these criticisms go back to the 1980s and 1990s, when the World Bank implemented structural adjustment programs, SAPs, across several African nations. These programs aimed to stabilize economies and promote growth by enforcing drastic cuts in public spending, privatization of state assets, and economic liberalization. However, while the intent was to foster economic growth, the reality for many countries was quite different. These measures often exacerbated poverty, reduced access to essential services like healthcare and education, and in some cases fueled social unrest. For many critics, this was the first sign that the World Bank's interventions might not be serving the best interests of borrowing countries. Another major concern is the erosion of sovereignty. The loan conditions set by the World Bank often strip borrowing nations of the ability to make independent economic decisions. Essentially, these countries are left with little room to craft policies that suit their unique needs. Instead, they must comply with a strict set of economic reforms dictated by the bank, or risk losing crucial financial support. This loss of national autonomy is seen most clearly in IMF loans, where countries are required to implement strict economic reforms before any funds are dispersed. Beyond economics, the environmental and social consequences of World Bank projects have also drawn severe backlash. For instance, large-scale projects in countries like Indonesia and Ethiopia caused widespread deforestation, biodiversity loss, and the displacement of local communities. In many cases, these interventions not only disrupted traditional livelihoods, but also escalated social tensions. The decision-making processes of the World Bank are often criticized for favoring the political and economic interests of its most powerful shareholders, typically nations from the global north. This has led to interventions that critics argue are more aligned with the interests of these wealthy nations than the actual needs of the borrowing countries. Even when the World Bank's own independent evaluation group issues recommendations for improvement, there's often a failure to effectively implement those lessons. All these issues are compounded by a sense of mistrust from the Global South, driven by the historical context of colonialism and ongoing economic inequality. Many developing nations feel that Western countries prioritize their own geopolitical goals over the development needs of poorer nations. A stark example of this disparity is seen in the unequal global responses to crises. Compare the substantial aid given to Ukraine to the often unmet promises of aid for developing countries. In response to these challenges, China, as a founding member of BRICS, established the Asian Infrastructure Investment Bank, AIIB. The AIIB was created to offer a more equitable alternative to the World Bank, specifically targeting the development needs of the Global South. But before we dive deeper into the advantages of the AIIB, let's explore some of the major failures associated with World Bank loans. Structural adjustment programs in Africa. In the 1980s and 1990s, the World Bank and IMF's SAPs had devastating effects on many African nations. Zambia's experience with these policies led to the collapse of local industries, widespread unemployment, and an overall increase in poverty. The critics argue that the programs prioritized debt repayment over social welfare, leaving long-term scars on the economy and society. Mozambique's hidden debt crisis. In 2016, Mozambique's undisclosed loans, which amounted to over $2 billion, triggered a severe economic crisis. These loans were backed by the government for projects that never materialized, leading to a collapse in investor confidence, sharp currency depreciation, soaring inflation, and eventual default. The crisis highlighted the lack of transparency and poor governance often associated with World Bank-backed projects. Argentina's economic crisis, 1999-2002. By 2001, the country defaulted on its public debt, plunging the nation into widespread poverty and unemployment. Critics believe the stringent loan conditions and the rapid shift to neoliberal policies, without adequate social safety nets, contributed to this collapse. Greece's debt crisis, 2010. Even in Europe, the World Bank's loan conditions led to disastrous outcomes. Greece was forced to implement severe austerity measures, which included deep cuts to public spending, pensions, and wages. While these policies aimed to reduce fiscal deficits, they instead led to a significant economic contraction, skyrocketing unemployment, and widespread social unrest. Indonesia's environmental crisis. During the Suharto era, World Bank-funded projects in Indonesia included large-scale transmigration programs, which caused massive deforestation and intense social conflict between local and migrant communities. The loss of biodiversity and the destruction of ecosystems became a lasting legacy of these programs. Now let's discuss the AIIB and how it compares to the World Bank. China's frustrations with the World Bank and the IMF, especially over its underrepresentation, motivated the creation of the AIIB. The goal was to reform global financial governance and better reflect the economic realities of the 21st century, giving developing nations a louder voice in international financial decision-making. The AIIB also emphasizes regional stability. By investing in infrastructure, it aims to foster economic growth, which in turn promotes political stability, a key component of China's broader strategy for regional prosperity. There are several key differences that give the AIIB a competitive edge over the World Bank. First, the AIIB is more efficient. It has a non-resident board, meaning it meets periodically instead of constantly reviewing loans, which speeds up project approvals. This is a major draw for countries needing quick funding. Second, the AIIB imposes fewer political and economic conditions on its loans, unlike the World Bank, which often ties funding to sweeping reforms. This flexibility is highly appealing to developing nations seeking greater control over their economic policies. Third, the AIIB is laser-focused on infrastructure development, a core pillar for economic growth in many developing nations. This contrasts with the World Bank's broader mandate. By 2024, the AIIB is projected to have a loan portfolio of $90 to $100 billion, placing it among the world's largest multilateral banks. With an annual investment of $10 to $13 billion in infrastructure projects, the AIIB is quickly scaling up its operations to compete effectively with the World Bank. The rise of the AIIB highlights a broader shift in global economic power from Western-led institutions to emerging economies, especially China. Countries are increasingly opting for the AIIB's faster, more flexible approach, which is seen as less intrusive than the World Bank's. This trend underscores China's growing leadership in international finance and its strategic ambition to reshape the global economic order.